We're always in search of the perfect strategy, and unfortunately there's not one size fits all, but I'm going to do my best to show you the simplest way that you can use real estate to actually retire financially free, early retirement, and enjoy the benefits of being young and doing whatever the F you like. If you're interested in my thoughts, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, financial freedom is so important. When you go out there onto YouTube or you go onto Google and you're like,
hey, how do I actually invest in real estate to actually retire?
And you're gonna see so many conflicting views. And so I thought, why not make it more confusing for you guys and share my thoughts? No, that would just be mean. What I'm actually gonna do is try and simplify it so that you can use the tools in this video or the strategy and then have your mindset really adapt to what you wanna achieve and how you can go ahead and execute. I've got my whiteboard here, so let's jump into it. So the perfect strategy. Now for me personally, I think the key is the foundation. If you go out and you decide to build a house and you think, I'm gonna start with what color the roof will be, you'll fail. And unfortunately, we don't spend enough time looking at the structure, the slab, what's underneath the ground, so I can actually have a good foundation for the property, and what color the roof is comes later in the process. And this will all start to make sense as we go through this. So if we're looking at building the foundation, we want something rock solid. In times of economic turmoil, the properties will continue growing, continue giving you cash flow, and then when times are amazing, these properties will still be in demand and continue growing as well. So I believe if we were to do this quite well, we would be looking at minimum of 5 to 7 years. Now you might hear that and say, I'm discouraged by that because I want to retire in 4 years, I want to retire in 3 years. Well, then real estate's probably not for you. You're taking shortcuts in an industry which can take a long time. I've talked to people that have been investing for the last 20 or 30 years, and unfortunately some people have, taken the wrong turn or purchased the wrong investment, but they're still at it. They still haven't reached financial freedom. Now there are ways to get to financial freedom early within 10 to 12 years. And I want to show you exactly how that would work. But then it comes down to going, I've got the information, but I need to execute. Something I need to make you aware of is by not actually doing anything, you lose every single day. So it's almost like I stay in the same position, but the rest of the world continues moving. And then I open my eyes and say, oh, how did things change so quickly? And if we were to use a real life example of that, it's people that have sat there over the last maybe 5 or 10 years and said, I could buy, but I won't buy because it's apparently a really bad time to buy. And you do that every single year, hoping that my savings will continue growing. If you think about how much inflation is in the system over the last 2 to 3 years, you've in fact lost probably 15 to 20% worth of compounded money in terms of your savings. If you then go and look at the opportunity cost of using that money to then go and invest, and if you had invested over the last couple of years, you would be so far ahead with those leverage gains. It's why it prompts me to make these videos, because if you're not making moves, then the only move you've made is in fact backwards. So let's continue. So if I was to build out the foundation, what would I do it with? Well, right now, if you can buy a 400K property, I would be looking at a house, and I would do this every year for the next 5 years. Keep it really simple. Now, first question might be 400K. What am I buying a unit? Am I buying in the middle of nowhere? No. The market is really big here in Australia. There's multiple markets. And so when you look at those markets, you'll realize there are pockets out there where you can purchase brick homes for under 450K. That's the sort of stuff that we do at the buyer's agency. I'm not going to plug you with anything, but I just did. So definitely go check out this video once you're done with this one. So if I went ahead and purchased these 400K properties and I purchased 5 of those, that would mean my asset value, my property portfolio would be worth $2 million. So at an average growth rate of say 7%, and we assume a break-even cash flow, which again, I know is a lot harder today given that interest rates are where they are, but what you want to do is look at long-term averages. If you looked at the last 10 years at the average mortgage rate, it would be less than what it is today. So that's what you need to consider when you're looking at real estate. It's that when rates are really low, it's never going to stay there for too long. And when rates are really high, they're never going to stay there for too long. So we take an average. If we had a break-even cash flow and 7% growth every year, after 5 years, that $2 million will have made $800,000. And that effectively means that your portfolio is 2.8 million. And after 10 years, you're at $3.9 million, almost 2x whatever your initial investment was, which was the $2 million. Now we know how real estate works, which is I didn't actually need the $2 million. I could go out there and put 10% towards deposits, plus the costs maybe about 5%. So realistically, I'm probably in about 3 to 400K in order for me to be making $1.9 million over 10 years time. So let's say we are at this point. We now have a crossroad where we could go down the path of, I want to buy my principal place of residence and pay off my debt. So I'm happy. I don't need any more properties. All I want to do is keep the 5 properties that I have have, and the rest of the money now that I make, I want to go buy my principal place of residence and pay down my debt. Alternatively, you could be young like myself and you'll say, well, look, I want to keep buying investment properties. My money's going to grow a lot faster in investment property than it does in my savings account. I don't really have any intentions to buy a principal place of residence anytime soon. And if I did, I could just sell a couple of these properties and I'll still be further ahead than if I had just saved my money. So we're at that crossroads. Let's explore what these options actually look like. So let's say, for instance, you decide, I want to buy a principal place of residence. I've been renting and I've been watching Ravi's videos. Rent vesting's cool, but now I want my own place. Totally understand. So your current portfolio after 5 years is worth $2.8 million. Your equity is about $800,000. So your current debt at the moment is about 1.7 mil, and your principal place of residence, should you choose to purchase something for 1.5 million, means that you need $225,000, which would be, your upfront 10% plus your 5% for costs. How would you actually get there? Well, your borrowing capacity needs to be 1.7 plus 1.3, the 1.3 being for your principal place. That means you would need a borrowing capacity of about $3 million. Now this sounds like a lot because it is. How would we sort of break down those numbers to say, is this even possible? Let's just look at a rough formula. Now at a DTI, which is debt to income ratio of 6, which again, I know is at the higher end, we would need roughly $500,000 worth of income to be able to get a loan for about $3 million. Now, again, plus or minus some numbers here, you'd need to talk to a broker specifically about this, but let's say for instance, you needed 500K. In this case, we know we have property. So at a 5% rental yield of 2.8 million, we have 140,000 coming from our rental properties. Then that would mean we would need a household income of $360,000. Now, let's just take a pause here because I gloss over some of these numbers and I make it sound like it's pretty normal. 2 million here, 3 million here. Oh, everyone's making 300K a year. No, I totally understand this isn't normal. And I understand as well that not everyone is in this position to be able to execute for 5 properties and then buy their principal place of residence. But I also understand that many people don't want to buy a $1.5 million house. You might be satisfied with a $500,000 house. And then the numbers change as well. I want you to take away the formula and the thought process and then apply it to your own life. So in this case, if you could afford this, after 5 years, your principal place of residence, which is 1.5 million, your investment portfolio, which is 2.8 million, means that you have $4.3 million in real estate at that point. Assuming a 7% growth, that would mean $301,000 every single year compounding. Now, in some years, it might grow more than 10%. In other years, it might drop by maybe 2%. But when you average it out and you get to 7%, you're making about 300K per year. Now, in 5 years from now, your properties are probably positive cash flow. That's not because you've paid down some of that debt. It's more so because your rents will continue going higher if you're in the right market. So you might have each property giving you about $7,000 in positive cash flow. And that means you're making about $35,000 a year from your investment properties. Now, in this situation, you pretty much have 35K coming from your investment portfolio, and that could be then going towards your home repayments. You also have 300K worth of equity growing in your portfolio. And this is such a powerful position to be in because you now have the machine that continues growing, and that equity is growing tax-free. This is why it's so important that you start as early as possible. And even if it's just one property now, and then you can compound that in 2 or 3 years, I would urge you to start. Dip your toes in because you will then start seeing the benefits 5 to 10 years from now. I can tell you now from my own experience, 10 years ago, I bought my first property and I sat there and I was like,
This is cool. Didn't change my life, but I hope the process works. I'll trust the process.
And now 10 years later, with knowing everything I know and how that portfolio has developed and grown, I would go and do that all over again. Probably try to do it twice the speed, but that's a different story. What's the alternative is the next question. If I went and continued rent vesting and paid down my debt, what would I need to do? Well, I could pay extra towards the 1.7 million worth of debt. It would be paid off in 10 years. My investment portfolio would be worth 3.9 million and I would be debt-free in about 15 years. So what I mean by this is that you could go down the path of, hey, I don't want to buy my principal place of residence. I'll keep the level of debt I have. In 10 years time, my property values have gone up, my rents have gone up. And what I've done is I've gone and used all the extra cash flow, the extra money I make from my active income, be it a job or business, and I've gone and plugged that in to paying down my debt. I could be debt free in 15 years and have a portfolio worth about $4 million. And now I can rent pretty much anywhere, and that would be paid for with my positive cash flow property portfolio. Another option down this path is you could actually sell 2 of the properties, and you would then reduce your debt and use the the equity to actually go ahead and buy the principal place of residence. So in this case, if you think you don't have enough income, you could then go, well, let me get rid of some of the debt that I have. I use the cash, and then I can use that cash to actually buy my principal place of residence with a higher deposit and lower amount of debt. So after 10 years, the principal place of residence I purchased for 1.5. The investment portfolio is worth 3.9 minus 1.6, which means the total net value of my portfolio is about 2.3 million because my debt is about 900,000. Now I could use $600,000 to $700,000 worth of cash and put that into the principal place of residence because I sold the properties, I've taken the cash, I now use that as a deposit for my principal place of residence. And that means the debt is 1.5 minus 600K, and that means $900,000 worth of debt on the principal place of residence. The beauty of this video being a video is that you can go and rewind this, you can slow it down to go, okay, did that all make sense? If it didn't, just rewind and you'll be able to pick up on it. Therefore, the value would be 1.5 being the principal place of residence plus the 2.3, which is the properties that I still have, the investment portfolio. That would mean $3.8 million against debt of 1.8 million, and that would mean an LVR position of 47%. This is why when you actually look at how much the average loan is, or how much the average loan to value ratio is here in Australia, it's actually quite low. It's closer to about 30%. So despite you going out and buying a property at say 80 or 90%, over time, as the value of that property increases, despite you paying no debt down, you'll actually have that LVR continue to drop. So just to summarize with my fantastic drawing, your principal place of residence would be worth 1.5 million. Your investment portfolio, you'll only have 3 left because you sold 2. That would be worth 2.3 million. Now, as time goes on, you have compounding growth, and it's very important that you realize capital growth is important, but so is rental growth. So a combination of these two allow you to keep maintaining your lifestyle and allow you to hold this machine for a longer period of time. In addition to that, your active income needs to continue growing. If you're in a job that you really like, fantastic. But if you then say, well, I also want to take out more debt, you're going to have to get uncomfortable. Buying 1 or 2 properties is actually quite simple. It's quite easy to execute. When you start going out and trying to build a portfolio and you think, how do I actually get there? You need the right tools, but you also need to go and put in the hard yards, because what you're trying to do, less than 1% of the entire population will actually get to experience. You're going to have to grind a little bit harder, take up some jobs, do the side hustles, keep getting promoted, move around to different jobs. Whatever the case is, you need to know that your active income is so important because that allows you to get access to debt, and debt is what we need to be able to build this portfolio a lot faster. And finally, this only works, of course, if you buy in the right markets, the right properties. This all goes out the window if any of those 5 properties is a dud. That's why your foundation is so important. Get the right properties in there, get the right team around you. And if you need the help with actually executing, buying in the right places, then definitely send me an email or go through the website and you can check out client testimonials as well about their experience. And I'll leave the link in the description below for that as well. I hope you guys have enjoyed this one. I'll catch you on the next one. Thanks, guys.